Welcome back, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And we got a pretty stacked panel. You know, like I kind of, listen, I promoted pretty hard, but, you know, I have to say it again. It's a stacked panel because we got a stacked topic. This is important. We got a lot to say about this. So without further ado, let me introduce. I'm going to start with it's not a dark square, but it's our voice from above joining us. It's Bill Brewster from Sullimar Capital. What's up, Bill?
How's it going, everybody?
All right. We got Jeremy Deal from JDP Capital. What's up, Jeremy?
Hey, how you doing?
All right. We got Stephen Keel from Arquitos. What's up, Steve? Look, he's fresh from Abu Dhabi, and he's got a beard now and glasses and in a suit. I mean, look at this guy.
Trying to keep up. But I got to say, Bill and Jeremy have such pleasant voices. We have to have you guys on more often.
Yeah, this is for sure. Bill's got that good. He's got that good mic. You know, look, he knows what he's doing, man. And then we also got new to the panel. Well, Bill is also new, but new, fresh for me. We hadn't met before this, so I'm really excited to welcome him on here. It's Francisco Oliveira from Arivelo Capital. I said that correct, right? Arivelo?
Yeah, Arivelo Capital. Thanks for having me. I'm excited about this.
It's great to have you on. All right, so let's dig right in. Our topic today is streaming services and the future of media. Now, this was a topic I wanted to do a couple of weeks ago, but one person on this panel, I really wanted to be on this because we had talked about it in our individual podcast episodes. So he's here right now, so I'm going to let him kick it off. So Jeremy, let's just do your general first take. Streaming services, future of media. You know, what's your first thoughts, and then we'll go from there.
Well, my fund is invested about 60% of our capital is in and around the sector. We're really excited about it, and not excited about all parts of it, but just generally excited about what it means to, you know, how the industry is evolving, ad tech in general, and what is going to be possible with advertising. And so I guess if I was to start, I would say, you know, looking where it's an industry that I've been fascinated with because where we've come from and where we are today versus where we're going are just so dramatic. You know, if you think about 20 years ago, when you wanted to advertise, you looked at a billboard or a radio station or something, and you just had no way to measure the results. So you'd spend a fortune on an advertising campaign, radio advertising, or billboard or whatever, and you just had to hope. You had no way to measure, you had no way to understand the return on investment that you were getting. And so some of the early ad tech players like Google created, you know, an opportunity for people to target and measure things, but it was limited to kind of their own ecosystem. That Facebook came along and kind of introduced the world to what was potentially possible. And over the years, we've had just a migration of technology, just an explosion of technology that is essentially allowing a lot of smaller companies to create results for advertisers and allow brands to advertise in a way that's measurable and just opening up an enormous opportunity. And then, you know, going out longer term, the opportunity to take it to not just replace old economy with new economy and replace, you know, newspaper revenue with ad tech, you know, maybe more like a OTT campaign or something, but to pivot into actually converting those advertising into sales. So we call T-commerce, for example, in television, or creating that interaction between, you know, the consumer and the advertiser is just we're just in the very, very, very early stages of that. So it's a very exciting sector. And the three companies that we're invested in that we like are Roku, Cardlytics, and Spotify. Spotify is not just an advertising company, but it is absolutely an ad tech type of business. And we like those businesses because they control the eyeballs, they control the demand. And so just full disclosure, you know, kind of where I'm talking from today is probably from the perspective of one of those three companies or all three of those companies.
Very cool. Stephen, you want to jump in?
Yeah, I mean, I think the most exciting thing recently is what Spotify is doing in the podcast network, which probably most of us are aware of. Certainly you are, Bobby. And I mean, people are just listening here. Bobby is making gestures there, me, but it's an interesting kind of next generation specification on those things, and we'll see how it all pans out. Because if just think about the podcasting in general, I mean, I download podcasts in advance and then listen to them afterwards. Where Spotify is betting on kind of a streaming service in the future, where you can geolocate ads, and you can really specify ads, based on specific interests and things like that, like other services do. And is there enough revenue in that? It's same idea why Google's YouTube did the YouTube TV. The idea was that they can offer the cable services cheaper than traditional cable, because they could make the ads more specific and therefore charge higher rates. And I think we're really in the first or second inning of this. In the next 5 or 10 years, that kind of specification will, I think, dramatically increase. Therefore, the efficacy of these ads will dramatically increase. And all of us have probably seen, I'm searching for something I want to buy. I buy it, and then I still get the ads for the stupid thing I'm searching for the next 2 weeks, right? And this is the early days that, they know you're searching for it, but they don't know anything else beyond that. So we have some specification, but it's still kind of dumb in that way. And, I think as we progress to the third and fourth and fifth inning, we'll see some very interesting advancements in that area. Spotify could be a leader. Certainly, but it remains to be seen. It does kind of demand faster streaming speeds, perhaps 5G and other things associated with that. I like the idea. I like the potential for sure. And I think there are other companies that will reveal themselves over the next few years that are other than a Google and an Amazon and Facebook, and maybe they'll get bought out by those companies, or maybe they'll threaten some of those companies over time.
All right. So Francisco, can you explain to Steven the concept of cookies? All right. And clear cache. Okay. So he doesn't continue to get those same ads popping. But
no, yeah.
I'm kidding. Francisco.
Who doesn't like cookies and cash?
Who doesn't like cookies and cash? That's what I'm saying.
Those are two of my favorite things, actually. But why do I have to manually do that? Why can't why can't Google Chrome automatically do that once they read my email, right? They know I ordered it. Can it clear it out on its own? Maybe that's the next inning of this.
Maybe that could be inning 4. All right, Francisco, take it away.
I think what's interesting about this is, in the streaming market in general, we can come from many different angles. And Jeremy talked about the ad side, and Steven as well. And you also have Spotify, the audio side. But you also have what's been very popular lately, the streaming wars, right? So Netflix dominating and disrupting the pay TV bundle, but also forcing legacy players to come in the game, with HBO boosting its service, trying to go global. You have obviously Disney coming in, you have Apple coming in, you have CBS and Viacom merging to launch a new service as well. You have smaller players that have more niche type of services, like from AMC. And you also have Amazon in its platform as well. So everyone's investing a lot of money here, and they're all trying to get the eyeballs. And what I think is interesting to me is that I'm not really sure there's going to be a ton of winners here. And there's people who are sort of all in, but not really all in. And there's other players that live by this, such as Netflix. Full disclosure, I do own shares in Netflix and Spotify as well. But so what's the stakes are getting bigger. The amount of capital that is needed to play in the space is getting bigger. And I'm not sure there's going to be, basically a field of dreams for everybody entering the space. But if you are able to stay in the poker table, if you will, as the amount of money needed to be invested in this space increases, I think the bigger players have a huge opportunity ahead, and not only for the pure play services, but also using the service to sell their things, right? Netflix is pure play, but if you stream a lot with Amazon, you're more likely to, buy toilet paper, as they say, but you might also attach other streaming services via Amazon channels. Apple wants you to use their Apple TV Plus, but they also want you to potentially pay for CBS All Access attached to that, and also keep buying an iPhone and an Apple Watch and an iPad and so on and so forth. Disney wants you to stream to Disney Plus, and it also wants you to watch The Mandalorian, buy Baby Yoda dolls, go to the theme parks when they open again, and buy lunch boxes and et cetera, et cetera. So everyone's coming in here from different angles, and so there's the ad tech side, but there's also pure streaming players and streaming players that really want to sell their services and products attached to that.
Absolutely. That was actually one of the notes that I took from Jeremy's opening that you just mentioned too here, is that this idea of, ad tech versus streaming services. And then I'm sure there's going to be some overlap with some companies that are doing a little bit of both. I mean, like a Spotify is kind of doing a little bit of both. So Bill, I know you only have a short amount of time here joining us today, so I thank you for spending their time. So let's get your take too, and then we'll kind of take it again.
Well, first of all, thanks for having me, because I'm not sure that I belong in this company. I'm just I'm punching above my weight class here.
Oh, well, that's life
most of my life
space,
as well.
All right, bro. So it's totally welcome to the club.
So I think Francisco and I are going to have similar ideas because we talk almost daily, or well, definitely daily. He's probably the sharpest media guy I know. So I guess as far as disclosures, thinking about how I would disclose in this, I mean, I'm long Charter and the related entities. I'm long Altice. And the reason that I think that's relevant is that's one way that I'm playing this trend, specifically the streaming of video. I think the idea that you are going to be able to have a broadband connection that you can't rely on is laughable. I think it's table stakes now. And they are important to that. As far as the companies that I own that are in the streaming space, I mean, I own Disney, and then I own a little bit of Netflix and Spotify. Disney is the only one that I am I have a lot of confidence in Disney. I have a moderate amount of confidence in Netflix, and Spotify I'm sort of closer to on the fence about. So that's sort of how I come at this. And I'm happy to expand on anything, but that's probably the most relevant stuff for now.
Well, I mean, I know we don't get usually into specific name, but I think there's a thematic ness to some of the things that you just said, in how you're feeling about some of those companies in particular. But, it seems like everybody has some exposure to Spotify on here. So I'm just curious, throwing it right back to you as to why you're more on the fence with Spotify and what's happening right now.
I guess the difference to me between Spotify and Netflix, so a core operating thesis that I hold is shareholder bases matter a lot. And the thing that Spotify clearly has to me is a shareholder base that is not only willing to look long, but also encourages it. And I think that's, I mean, to me, you can look throughout a number of business stories, but patient shareholder bases that let visionary CEOs do what they want to do is a very, very strong combination. The thing that worries me about Spotify is there is a lack of differentiation between what they offer and what like Apple offers, for example. And I think that it's objectively true if you look at the labels, how much they have started to earn from streaming. It's objectively true that streaming is extremely important. I am not 100% there on whether or not I think that Spotify is going to be able to crack enough of the code to justify the current valuation. I guess that would be the only thing that I'm more uncertain about. Whereas like Netflix, even though I think that it's easier to argue that it's overpriced on today's metrics, I have a higher degree of confidence in where I think that business is going. And I think that their scale advantage is almost insurmountable at this point.
Gotcha. Anybody want to jump in?
I think one of the things to look at is generally over time, these things turn into oligopolies, right? So if you have platform, whether it's platform video, platform audio, et cetera, who are the 2 to 3 winners? Who is the Visa, MasterCard, American Express out of these 3 groups? And those are the ones, obviously, you want to be able to bet on over time. And we have some clear differentiators right now. And I'm not so certain that those will be the leaders in 5 years from now, 7 years from now. Because, you think about Apple. I mean, Apple could have dominated the podcast network and just didn't, right? And you have other examples as well. Amazon could have done certain things too. And they've just, whether they chose not to, or they missed the opportunity, or they did not take advantage of their user base in the way that they could have. I think that's what's interesting looking forward. I don't know who those winners are. I think, you can see who the lead horses are at this time. But that doesn't mean those are going to be the 3 main companies at that time. And essentially, you want to be in those 3 main companies in the future, because that's when those returns on equity end up being, or returns on invested capital end up being, higher. The margins are higher, and then all of a sudden you're able to cash in on that platform that right now they're developing.
Right.
I think what's interesting about Spotify to me is that you can look at the sort of bear case, right? They have Apple with unlimited funds, right? Investing in Apple Music. And you have their relationship with the labels, Spotify's relationship with the labels, that it's a difficult one because the labels just command such a high percentage of revenues. That's tough to be extremely profitable when you're paying 70% of your revenues to basically a small group of labels, 3 main labels. But what's interesting to me is when you look at the other side of it, is that who's doing something that Spotify, like who's doing exactly the same thing as Spotify, or really competing with them? Because when I look at the competition, I really look at it extremely fragmented, and Spotify's differentiation is actually growing over time. Apple Music is basically a service for Apple users, right? And we know that the majority of smartphone users are not Apple users, even though the Apple users are extremely valuable. And then Apple Music is not really getting into podcasting because Apple has another service, and Apple's really is not clear to me that they're investing a ton of money in that, and especially in getting actually tools for podcasters, creating relationship with podcasters, and also creating high demand exclusive content and testing different type of content. And Spotify is really all in, and basically we want to be all audio, right? We want to have music, but we also want to have podcasts. They've tested things around audiobooks and hired a head of audiobooks. You can imagine that over time they'll experiment with live type of content and more news and possibly sports and possibly concerts and live events. And they're getting basically the best, the highest demand type of podcasters exclusively on their service.
Yep.
The Joe Rogan Experience is obviously exclusive, but they're probably going to, if you are starting a new podcast and you're very high in demand, what's going to give you the biggest global exposure and reach? And if you look at some recent deal that they signed with DC Comics to create original exclusive comic book stories, they did it with Spotify because Spotify is going to give them the biggest exposure. Marvel signed a recent deal with SiriusXM and Pandora, and Marvel is obviously more popular in the movie space, but I would argue the DC comic book type of audio podcasts that are coming out on Spotify are going to be listened to way more people than the Marvel ones on Pandora and Sirius. And Spotify's strategy of being basically ubiquitous, any phone service, any smart speaker, any smart car, any laptop, basically everywhere you can get the app, it's possible to listen to something, they're going to be there investing that. And it kind of reminds me how Netflix is basically on any new smart TV and the button and the remote. Well, Spotify has that type of attitude. So being able to get the biggest audience, even though you have a tough relationship with the labels, if you invest in different type of content over time, I think you can basically create a really good business. Is the free cash flow going to be enormous over the next 5 years? Probably not. But if we rewind 5 years ago and you told me that Netflix was going to burn, I don't know, close to 10 billion or a little bit less in free cash flow, maybe I would have told you the stock price wouldn't be where it is today. But obviously those investments have paid out. And I think Spotify has their eye on the ball. And Jeremy probably could touch on this because he touched on the ad space, but creating this investment for all these exclusive content also creates other revenue opportunities, particularly in the ad space. And they made an acquisition there this week. That could be interesting.
Listen, Jeremy, before I get to you real quick, I mean, look, I was sold on starting to use Spotify for podcasts when every time I'd be on the Apple one, it would drop every single time. I was like, this is just driving me nuts, like every single time. But I digress. That's why I went Apple to Stitcher, and then I finally was like, wait, I'm paying for Spotify, and they got all my favorite podcasts on there. All right, I'm now going to use Spotify. Full disclosure, I'm not a shareholder in any of the companies that have been mentioned thus far. Jeremy, your thoughts?
Yeah, I agree, Francisco. I think it's important to think about where a company has been, where it is today, and where it's going. And so my perspective is that there's an enormous differentiation between Apple and Spotify. When Tim Cook gets up in the morning, he's not thinking about Daniel Ek, and he's not thinking about how am I going to make a better experience for my user base in audio, specifically around podcasts, and what can I do with that, and what does the future look like that. I don't believe that's their objective at all. They're a hardware company. They always will be. And I think that their goal is, despite whatever in the media, I mean, companies like Samsung, hardware manufacturers are always trying to be software guys. They're always trying to do that. And it's just not going to be the case. So I'm very comfortable with the idea personally that Apple is really not the issue for Spotify, or even a threat in any capacity. Otherwise, they would have at this point gotten remotely close to their subscriber base. And where Spotify is going, though, is, you're right, it's not completely clear. What I like about it is a lot of what you all touched on, and what Bill, you touched on as well, is that you've got a shareholder base, you've got a founder controlled board that lets them take risk and lets them make really long-term investments. And when Daniel Ek gets up in the morning and he goes on his famous 1 or 2 hour walk, even when it's cold and dark in Sweden, he thinks about, like, what are we gonna do today to compete? And if I look at the progress they're making and where they're going, they're using, kind of like Ben Thompson talks about, the rungs on the ladder. So, Spotify kind of invented the streaming market for audio, but that's just where they began. The idea of just offering streaming for music is a long been a commoditized concept. Anybody can do it. There's really no barriers to entry, but you have to kind of look at all the shots that Spotify is taking to monetize audio, because audio is extremely under monetized relative to video. Maybe it's 10% monetizable relative to video. And a lot of it is just because there's a lack of an ability to trace and track and pay and target, just like in other types of media. And so Spotify's progress and focus on the artist is really fascinating to me. The idea of the two-sided marketplace and the Spotify for artists is probably the driving thesis that I'm interested in personally, and why we're so invested in Spotify. I think that their opportunity to unlock value in audio is just enormous. The opportunity to allow targeting and work with the labels in order to grow is, the labels need Spotify more than Spotify needs the labels. And I know that sounds a little bit crazy, because it sounds like, how does Spotify exist without the labels? But it's not this kind of, we need to work in it. Every day, if you go back to the labels, even 5 or 10 years ago, they had very, very little value. They might have been worth, 5 or 10% of what they're worth today. They're really worth what they are because of the effort Spotify's put in, and now a little bit, streaming with with the other big players as well, Amazon and Apple. But the opportunity to unlock in the near term advertising dollars from the labels and provide marketing in a way to reach new fans for music that just wasn't there before is enormous. And one of the examples I was reading about recently, you guys probably read this, there was an example where a guy on TikTok, now this isn't Spotify, but it's an example of how this works. There was a guy on TikTok that I'd never heard of called Dogface. And Dogface is this guy, this old guy that rides a skateboard around LA doing crazy stuff. And they played and he has a ton of followers or whatever. And he played a Fleetwood Mac song, an old Fleetwood Mac song from 1977. And Fleetwood Mac this song jumped to the top of the charts. And it's an example of a whole new group of people potentially heard and listened to that song and became a fan, even just for one time, listened to it in a way and generated revenue for Fleetwood Mac and for the label. So imagine that times, infinite. The opportunities are infinite, especially to interweave music and attribute music within podcasts, within short form video. There's just so much opportunity that's being unlocked and will be unlocked over time. We just see a very much a clear winner. And I know that it's hard for people to get their arms around the idea of how are they going to grow and how are they going to get their margins up. But we've already seen the very first innings, a very, very first beginning of how they're getting their margins up with the new two-sided marketplace and the margins higher. So instead of the artist paying or the record labels paying, they just pay a reduced fee. And so it has the effect of the margins growing out. So I feel like there is a clear path, much more clear than I think people think. And it feels to me that we're just in the very, very early innings, and the big guys it's just not their core competency. It's not competency. It's not their focus. And they're just there to offer kind of, there's a lot of ways you can just listen to music, but Spotify is just much more than an avenue for you just to listen to music.
Right. You think Steven, real quick, I want to come back to your thoughts on this, but I know Bill has to bounce. So Bill, you want to give your final take before you hop out of here?
Yeah, I got like 7 minutes, but I'll say my last smart thing of the day. I think maybe my first, who knows? I think that something that's interesting is I read in an expert interview that what is going on today in listening habits is kids are streaming the next song, right? And activating back catalog is actually pretty difficult among the current new crop of listeners. So sort of a mental framework that I had was, well, what is Spotify without all of the back catalog that the labels bring to it? And sort of what that interview made me contemplate is the idea that maybe the back catalog is way, way overstated on a go forward basis. And that the real issue is how do you get the next rap song or whatever the genre is that kids are listening to, once upon a time it was EDM. Yep. I guess now rap's back. Like the real question is how do we capture whatever heat is in the bottle today and drive listening? And, I have a cousin who manages artists, one of which is a hip hop artist. And, he's trying to get on Rap Caviar all the time. That's like a huge, it would be a big win for him. So it's been interesting. I think that there's real merit to saying that Spotify is at least one of two attention aggregators in a world where attention aggregation is completely disaggregated, for lack of a better term. And that real estate within that playlist is super important. And the idea that they're not going to be able to figure out smart ways to monetize that is sort of hard for me to fathom. And sort of a related thought, I'm sure that there's a lot of people out here that are probably listening and they're saying, why aren't you guys talking about what Discovery is doing or HBO Max or Peacock or any of this? And what I have begun to think about Netflix and why I'm comfortable I own it as like a tracking position, right? It's like one of these, I buy these things because my mind works much, much harder on them when I own them than when I don't. You got to fight endowment bias when that happens. But I think on balance, it's a positive for me. The deluge of content that Netflix is releasing and the quality that it's releasing, I think is actually attacking the value of an HBO back catalog. And I think that people that look at Netflix today and they say, well, it's not financially viable or whatever they perceive, I don't think that's even the game that Netflix is playing today. I think the game Netflix is playing today is we have so much capital and such great focus that we are going to destroy the competition. And when they are destroyed, that is when you will see our free cash flow start to harvest. And I know Francisco has some thoughts on what the pandemic sort of flashed for Netflix's financials, and I'm not going to front run them on that. But I do think that there's something very, very real to the willingness of capital markets right now. I don't know if it's interest rate related. I don't know if people have figured something out. It's probably a little bit of both. But the leash that these companies have to go out and kill the competition, I think it's going to be really, really, really hard to combat. And yeah, you could be Discovery and have a couple super fans. I'm long QVC. Lord knows I hope our super fans stick with us from a transition to Roku. But I'm not long QVC because I think their streaming future is bright. If that happens, I'm going to be pretty much not doing interviews anymore and retired on a beach somewhere. But like that's more of a I believe in the capital allocation coming back to me thesis. And I just think these subscale players, it's going to be really, really hard, especially to Jeremy's point. Like HBO Max is coming out of AT&T. AT&T right now is focused on DirecTV hemorrhaging losses or sub losses. They got a dividend requirement that they got to figure out. They got this 5G rollout. Like the management focus just isn't there. And I wouldn't want to compete against somebody like Reed with that shareholder base and that access to capital and that focus if you're them. And
I couldn't agree more, Bill, especially the idea about the overstated of the back catalog. I mean, the back catalog is such a tired story that the bears on Spotify have. It's just like, and same with Netflix. The idea that the back catalog, I mean, the back catalog is being created by some guy, Bill the rapper, who creates a song and a hit in his or her bedroom and puts it and uses the modern tools of today to get it out there and develop a fan base. There's a role for the catalogs to play, for the managers to play at some future date, but the value is much more, is on the side of the creator now. And so I couldn't agree more. I'm glad you brought that back catalog story up because as time goes on, we're seeing it shift in favor of the artist more so than the label.
And the distribution mechanism, right?
Yeah.
Like I think that's where I think more value will accrue to the distribution mechanism than some of the bears appreciate. So
yeah,
I got to jump, guys. It's been fun. I have marital obligations. Take care.
Get after it. Thank you, Bill.
Yep.
All right. So Steven, you were saying.
Yeah, then I think this is a question both for Francisco and Jeremy, then like talk about vertical integration. And, how does that happen? Does it happen over the next few years, both with audio and video? Less probably with video, more on the audio side. Does Spotify acquire a label? Do they start a label? Do they have some sort of direct to Spotify recording? Maybe they already do. That I'm not aware of. What are both of your takes on that?
I don't think they need to. I don't think they need
I'd
to
agree with that.
They, the labels, there's Warner Music Group who's public, and I think Universal might spin off soon or is in that process, or they want to sell. They're high multiple stocks, right? And then you take a look at the Warner Music's last 10Q, and it's a business under pressure, and they lump in digital revenue, streaming and digital copy sales, so it's going up, but physical copies are going down, digital copies are going down, streaming is going up, but within that, basically Spotify and Apple are your biggest sources. And as Spotify continues to grow, and they're going to be at close to, around 340 million users by year end. Could be around 400 million in a year or so. They keep talking about 1 billion users, and a couple of years ago that might have seemed crazy, but I don't think it's crazy anymore. If they have a platform with 1 billion users and the biggest growth driver of a label, the label has to play ball with them. And the label business is difficult because what Bill and Jeremy touched on, the back catalog, it's really hard to, it's much harder to monetize that today than in the past. But when you have a superstar artist, they want to have their own label joint venture, and they want to own their rights. They don't want to be part of the, Drake is not going to be basically a slave beholden to any label.
Universal.
Yeah, beholden to Universal or Adele or Taylor Swift or the next super mega star. They're not going to be handcuffed to any label. They're going to do their thing and their own terms and their own type of marketing. And if they do a Netflix documentary, it's going to be on their own terms. They're going to monetize, and it's really tough. And when you think a recent comment that Daniel Ek made is that if you're an artist today, you can't just do an album a year or every 3 years. You got to be out there constantly with the fans, music all the time, bang, bang, bang. It's a tough world. And if you have different labels competing with each other on on minimum guarantees with new artists, it's a tough business. I would rather be Spotify in the sense of continuing to grow your platform, giving tools to artists, giving tools to podcasters, doing exclusive deals or special windowing. And over time, the labels are going to have to play ball if you're a platform with 1 billion users. So I don't think that. And
it's a strange question.
Oh, no, I was going to say, I don't think they need to buy a label. And so that's.
But it is interesting because it's so counterintuitive to think like that. It took me a long time to understand the value in not owning the music. And it's something that I've heard Daniel Ek answer multiple times, but it initially didn't really, it seems like, well, that's what you want to own but it's kind of like the question, if you're Starbucks, why do you want to own the real estate? Would you rather own the real estate that the Starbucks sits on, or would you rather own Starbucks itself? And the leverage and the value is in actually owning the eyeballs and owning the demand, as Ben Thompson says, and not the supply. In the internet, you want to own the demand. And so it's really hard to own both. So if you focus on your expertise, and as Daniel Ek says, the job to be done, to own the demand, it's easier to monetize, and you can create more value with that music through your platform than you can if you just owned it yourself. Because what you need this self-reinforcing model where it attracts more artists and users to the platform, because it unlocks the value that wasn't there before for them to earn, whether it's a living or just get richer or whatever. Because kind of back to the marketing stuff that we originally talked about, if you look at the way that artists are marketing now, it's super interesting. They're one of the most popular forms of marketing is just doing live video of like their daily habits. So whether they're in their sweatpants, ironing a shirt, or going to Starbucks, or getting a drink, or like showing up kind of lazy to the recording practice or whatever, or then they have their fan base, and maybe they'll even some artists are releasing songs, just playing them in their living room, just, hey, what do you guys think about this? This, like, it's not produced, it's nothing, it's just raw. And this feedback loop that's happening as a result of the artist being able to kind of interact with the fans, is just, we're in the early stages of learning how that it can even be monetized. So Spotify's in a good spot, and it also helps the artists. If the artists can make more money, they'll depend on Spotify more, because Spotify controls that demand. And it's kind of a win-win-win for everybody, even the old economy labels.
Absolutely. So there was one question that I had too that also really kind of inspired this, and Bill started touching on it a little bit, in this idea of how, with Netflix really just going all in, pushing all their money towards, creating as much quality content as well. And there was an activist letter sent by Dan Loeb. You guys have probably all seen this, talking about why Disney needs to double down on its streaming spending. And then there was, of course, a counterpoint from Chris Bloomstran as well. But I thought it was pretty interesting to see that, there is this push of, and it makes a lot of sense to a lot of what you were saying, Francisco, earlier, where, it makes sense for a company like a Disney to, why not just push your chips all in on this right now? Because really, yeah, you're going to be getting the revenue from your subscription service. People are going to sign up and all that stuff, but their money is in selling all the toys and everything else. So it's almost like you push this here because that serves everything, the carrot over here. What do you guys think about that?
Yeah,
I think Chamath said something like, why would I invest in a company that has nothing better to do with their money than return it back to shareholders in the form of a dividend or a buyback? I've got thousands of companies I can invest in. This is one of the most incredible times to be a public company investor. Why would I invest in a company that's just like, sorry, I don't have anything better to do. I'm completely out of runway. I'm completely out of growth. So I'm just going to hand you back that capital. Why would I do that, especially as a small fund under 10 billion in AUM? And so to Dan Loeb's point, absolutely, I agree. Like, why on earth? Disney has so much opportunity to continue monetizing and to grow their streaming business. I think that it's a huge disadvantage and to the shareholders, for management and the board to look up and say, hey, we're out of things to do with this money, and so the only thing we have to do is just allow a double taxation of return of capital, just so this stock can sit in some dividend funds or whatever else. But I think, yeah, there's definitely more opportunity for Disney than just to hand cash back to shareholders. I mean, this isn't, it's not a declining business. So yeah, for whatever it's worth, I think Dan Loeb's absolutely right.
I think I completely agree with Jeremy. I think what Dan Loeb sees is that Netflix really changed the game and upped the amount of chips you need to make. It's like if you're playing, Netflix saw a bunch of kids playing water polo in a 4 feet pool, and now decided to let's raise that to 20 feet, and I'm gonna be 19 feet tall, and who's gonna come to play? And well, no one can play in that game. To Bill's point, they're investing so much good content, quality content. Not all is content that people will like, but the amount is so much, and the amount of subscribers that are getting is so high. The engagement keeps growing. It's really, really tough to compete with that. So I think, going back to Dan Loeb, and full disclosure, I own Disney as well. Forgot to mention that. Dan Loeb sees Disney and they're like, they can play in this game. We talked about how the back catalog in the library is not worth that much in today's world, where Disney's pretty unique in that their back catalog is actually worth a lot. And they've proven that with Disney Plus. They have over 60 million subscribers in less than a year. Today is actually the 1 year anniversary of Disney Plus. Disney reports tonight. Oh
shit! I knew I was getting hit on my card right now. Damn it! So I knew that was happening. Yeah,
but yeah. So 60 million subscribers in less than a year, and basically one hit show that's original, in the Mandalorian. So most of that, is being driven by the catalog, the attention that kids have. That some of it is due to bundling as well. But they can play in the game that Netflix is playing in without having to, spend $15 billion on their streaming service. They can spend, I think Dan Lowe is basically saying double your budget, maybe go to 6 billion, 7 billion. And you're going to be able to play in that game. You don't have to, you could be Netflix's size without investing the content, the amount of money that Netflix is investing in. That's an extremely profitable business for Disney. And then, like you said earlier, Bobby, it drives other parts of the business. So Dan Lowe's like, put the pedal to the metal, blow off the competition like Netflix, and you can play in their game and have an incredible business. And I think that is absolutely right.
I mean, they have so much stuff
They
that
do.
they can. I mean, they
Endless,
own so
right?
many
The
titles.
content is
Like,
unbelievable.
I'm also a huge
what are the
Marvel
odds,
fan, so
though?
I want to see more. But
What are the odds they
anyways.
do it? You know, we're talking about a corporation that has, you know, a different kind of setup according to its competition. It has the history, it has the bureaucracy, it has these other interests. You know, what are the odds that they go all in on it in that way?
I think the odds are high, in part because of the success of Disney Plus, and when you have that success, you want to keep the momentum going and push the pedal there. But also the pandemic, right? So it's made them reevaluate the theater business a little bit, where, you know, I don't think their mentality of pushing Avengers type of movies in theaters has changed, but maybe a movie that they would have spent $50 to $75 million. Well, maybe that's better for Disney Plus. Look, Hamilton, the play that Disney bought those rights for, I think it was around 70 million pre-pandemic. It was going to go to theaters, and it went to Disney Plus instead, and it was an absolute smash hit for the streaming service, and it drove a lot of new subscribers. And I think they saw that. They saw where the number of subscribers that they've generated, and they haven't even launched in Latin America, all of Europe, all of most of Asia, and they've gotten to these numbers. Recently, I think they started the pre-ordering of the service in Brazil and in Mexico and other parts. So they have an enormous opportunity to keep growing. And I think, you know, they already had to. Dan Loeb is kind of interesting because he said, don't pay a dividend anymore. Well, they stopped paying a dividend because of the pandemic. Well, it's kind of more of a mental thing. Like, hey, your capital allocation, you know, forget about returning, you know, kind of to Jeremy's point earlier, forget about returning it to shareholders. Disney has been actually pretty good about returning capital to shareholders historically. And Bob Iger comes from that school of thought, and they've bought back a bunch of stock historically and paid a good dividend. But now you have an opportunity to you're not paying a dividend. Your parks are going to take time to come back online, and just go for it. So I think besides the major blockbuster franchises, which we're only talking about a handful of movies a year, everything else, the priority is Disney Plus and their streaming services.
Well, the sky's the limit. You know, they really are and I think management understands this. Listening to their last few calls, now that, like, to your point, Francisco, that, you know, that Disney Plus has been unleashed, they realize they don't have to wait around for third parties. They own the distribution, and they can just do so much more is available to them as far as getting their products out to the market, that they can move with so much speed. And if I had to guess, my guess would be that Dan Loeb is really on management's side here. And because you have, to your point,
Agreed.
Steve, you have this old legacy kind of culture, maybe at the very top, or a board that has been beholden to certain institutional shareholders for a long time, that have been so used to this kind of payout ratio during non-COVID times, that you need an activist like that to come in and kind of force the change. And I'm sure management, you know, would love the idea of not paying a dividend, but they kind of need that push. They need to be able to say, kind of like, hey, it wasn't us, it was this big shareholder that kind of pushed this change, and now we've committed to this pipeline of like more production, of you know, turning up the dial on production. I've seen companies like that, you know, over the years, where there was a company that I was involved in a few years ago that management needed an activist to actually put the business plan into place, because you had this big shareholder that didn't believe in the management's growth plan, and essentially forced the management to not move forward with the growth plan, which ultimately tanked the stock and not ruined the company, but it really limited the upside. And so sometimes activism can be very beneficial to push the growth a little bit more when you have a shareholder base that just may be so entrenched and used to kind of just the same, and they just need that to move forward. But Yeah, just my thoughts on it, I guess.
Well, if you had Malone making the decisions, you'd have a tracker stock for streaming service right now.
That's right. Yeah, you would. And yeah, I mean, there's a lot of those Malone companies, they don't really have an option but to, if you're Discovery or whatever, I would argue that the best thing they can do is buy back stock, because they're going to be challenged for growth, and they do have infrastructures that are not really positioned to take advantage of trends tomorrow. But they're great businesses. They have amazing content and they'll do well, but they probably are more of the just do a levered buyback model and kind of like DirecTV did. And ultimately DirecTV was sold to AT&T, and it was a terrible deal for AT&T, a great deal for shareholders and all that. I think he had shrunk the stock by 80% over his ownership, and that was how he grew, because organically it was sort of just maybe flat, and then now it's been somewhat of a melting ice cube. And now now AT&T is sort of stuck with this property. They don't know what to do with, maybe sell it for less than what they paid. But there's a lot of cases where the buyback may make sense. But yeah, I think Disney has so much opportunity in front of it.
My final question, because I know you guys got to get out of here, but are we already starting to see the major players really kind of place their stake, like we are going to be the major player probably for a while now? And are we already getting into the conversation of like, okay, well then how do you carve out your own niche in this new media landscape? Are we just talking about niche media and making sure that you're trying to create content as low cost as you possibly can, that's as high quality, so that you ultimately do get bought up by these major stakeholders? I mean, are we already there yet on the streaming services side? Anybody?
I think if we're not there, we're pretty close. I think it's really tough to get to the scale of Netflix or even to the scale of Disney Plus. I mean, I think so. Disney, I mentioned earlier that they have 60 million subscribers in less than a year. I think Viacom and CBS, their combined streaming services don't even reach 20 million, and they've been, they took Showtime streaming and CBS All Access streaming at least 5 years ago, I think. So. And it's tough for them to take those businesses internationally, and I'm sure they're going to try. So the stakes, like I mentioned earlier, the water polo game, I think is really tough now, and people are going to try. I think Peacock is going to try, and with Comcast, but they have their hurdles. They're not. It's going to be tough for them to be a real global service. So Comcast owns Sky, so they have the UK market, German market, Italian market, and some smaller markets as well. I own Comcast as well, full disclosure. But taking Peacock to the global level, it's tough. And if you look at the deal that their studio has done, they've sold their DreamWorks animation kind of back catalog to Hulu, their Illumination catalog to Netflix. Their Universal movies go to HBO. It's going to take time to really clean that up. And the traditional studios are in a similar spot, even though many of them are part of conglomerates, but they're in a similar spot to the music labels in a sense, because the movie and television studios are always focused on selling each unit of content. Taking this Fast and the Furious movie and going to the theaters, then selling the DVDs, then going to HBO, then going to TNT, and profiting off each unit, because directors and artists also got paid on the revenues that it generated over its lifetime. And that game is basically over. And if you have to disrupt that and go to your own service, your service has to be differentiated. Look what it took Disney. The power of their differentiated content is what's gotten them to this level. And if you don't have that, and I don't think anybody really has that, then are you going to invest $15 billion a year to compete against Netflix? It's a really tough game.
I couldn't agree more. I mean, we're in a, we've come from a situation where the content guys controlled the whole ecosystem more or less. And that's changing. I mean, it's just like other industries, you're going to specialize. And so content may be king, but in order for it to be king, you're going to have to focus just on content. And we're in this stage where these guys are humming and hoeing, and they can't, they just can't, they're struggling to give up what they feel is what they used to have control of. So with the unbundling happening and people going to over the top and moving away from traditional cable, their content has value, but that's it. They need to kind of focus. They're kind of coming to that point where they're saying like, okay, look, we can really focus on this content, but somebody else is going to own that bridge to the eyeballs of the consumer. And that's a different fight. And that's probably not a fight that the content guys are going to be able to win. It's not the position they're in. People like Discovery are not going to be able to control nearly as much as they used to control. They're just going to be able to now make content, which is fine, but it's not the same business that Roku is in, for example. They are going to have to pay to be a part of that ecosystem, or they're going to, or if you're going to be, and also it's enormous opportunity if you want to start a content company. There's so many content companies that are coming up because they look at it and say, great, I could just create a show, or I can create some content and stream it on YouTube or Roku or whatever, and let them worry about it, let them sell ads, and I can monetize it that way. So it's ultimately beneficial to the consumer because the consumer wins with a better product at a lower price. But yeah, we are going through a phase, as Francisco said, like the big guys are kind of looking up and trying to understand what is their ultimate competitive advantage, and it has shifted. And content is great, and they're just going to have to kind of keep producing great content, and ultimately some of the tech native companies that are going to, somebody else is going to focus on distributing that content and monetizing when it comes to advertising.
Very good. All right. So I think we're pretty much there because I know you guys got to get going. So along with telling everybody where they can go and find more information about each of you, my quick one hitter is back in the day, what was that first Netflix DVD that you got sent to you and then sent back? I'll go first. I think mine was Smallville, and I binged the entire up until I think season 7. But you can follow me on Twitter at Bobby K Craft, BOBBYKKRAFT. Steven, let's start with you.
I mean, I'd actually have to think about it. I don't even remember because I think I was going to the Redbox stands over at the grocery store.
All right. So what was the first DVD at the Redbox?
Gosh, what year would this have been? I mean, maybe what are some of the new releases from like 2002? I don't know, sticking a dollar bill in there without even paying with a credit card.
Fast and Furious?
Maybe some sort of throwback like a Clueless or something like that.
There you go.
But at any rate, you can find me on Twitter, Steven_Kiel, Kiel. I'm at my fund is Arquitos Capital, which you can find by Googling, and also run Willow Oak Asset Management. Very
cool. Jeremy?
Yeah, I might have to echo Steve, and we may have been at the same grocery store. I mean, I remember going to the first Redbox at underground at my Ralph's in downtown San Diego, where I'm from, and it must have been one of the. I vaguely remember doing it for the first time and putting the money in and getting the rental out. It probably was a Jason Bourne, one of the first Bourne movies. More or less, it was around that time. So, yeah, that's right. The grocery store.
Love that. I love that.
It's still there.
And Jerry, where can people go?
Yeah, jdpcap.com, JDP Capital Management. And I'm not a big Twitter guy, but I do have an account as Jeremy Deal.
Very cool. Twitter. And Francisco, close us out.
I was actually a big Blockbuster guy, even though, when I worked in New York, I go to the Blockbuster as well. And I remember binging, I think the last kind of show, Mad Men, to catch up to where it was.
Catching up. Yep.
So before, everyone talked about the show, but it was really tough to catch up. So I remember getting the DVDs for that one. And you can find me, I'm on Twitter a lot. Franco Oliveira is my handle on Twitter. So I'm happy to chat with anyone in that medium.
Perfect. All right. Well, thank you all for joining me today. And thank you everybody for watching, and see you next week. Thank you.
Thanks, Robert.
Thank you. Thank you for having me.
Bye.